His indicator was developed by the famous New York trader Gerald Appel in 1979 to analyze the stock market, and then migrated to other markets, in particular futures and currency markets. Gerald Appel is also the author of several books, such as Winning Marker System, 83 Ways to Beat the Market, Stock Market Trading Systems, New Directions in Technical Analysis, and others, and also published his own newsletter Systems and Forecasts. The MACD indicator is a so-called trend oscillator that combines the properties of both a trend indicator and an oscillator. The MACD is calculated based on moving averages. The purpose of the indicator is to simplify the visual perception of signals sent by moving averages, reduce the delay, and remove a number of disadvantages inherent in conventional trend indicators. There are two ways to plot it: linear MACD and histogram MACD. The essence and features of the indicator. The MACD is an oscillator, although it is often referred to as a trend indicator, or even a trend oscillator. This happens because the MACD is based on the readings of two moving averages superimposed directly on the chart. These moving averages are not visible on the chart with the MACD, only their readings are taken. The MACD itself is displayed in a separate window under the chart, and looks like a histogram with an auxiliary line. The histogram shows the degree of divergence between two moving averages. If one moves away from the other, then the histogram bars also grow. If the moving averages converge, the columns decrease. Thus, if there is a strong movement, the MACD histogram columns will be long, and if there is a flat, they will be short. What the MACD indicator looks like. If the histogram is drawn above the zero line, it means that the fast-moving average rises above the slow one, gradually moving away. That is, the trend is upward. If the columns line up from zero down, the fast-moving average is below the slow-moving average, and the trend is descending. The auxiliary line that periodically intersects with the histogram in the indicator window is the moving average, which is already built on the readings of the MACD histogram, and not the price chart. This line is drawn to receive additional signals from the indicator. To avoid confusion, let's call it the moving average. Setting up the indicator. The MACD indicator is included in the standard package of tools of the MetaTrader 4 trading platform, and its installation is made in just a few mouse clicks. The easiest way to do this is through the Indicators button in the top menu of the terminal, setting up the MACD indicator, adding it. After that, the Indicator Settings window opens. Setting up the MACD indicator. Parameters. Registering a demo account. Here you can configure the main parameters of the indicator. Fast and slow MA are the same moving averages that are plotted on the chart and give indications for building a histogram. The greater the difference between their periods, the sharper the histogram will be. In most cases, these parameters remain by default unless the conditions of a particular strategy require otherwise. The MACD SMA is a moving average parameter of the MACD itself. The larger the parameter, the more the moving average will move away from the histogram, and the less often they will intersect. Next, you configure the parameter open, close, minimum or maximum of the candle, which will be used for the rest of the construction. Finally, the minimum and maximum of the histogram can be fixed at a certain level, above or below which it will not go. In other tabs, you can adjust the color scheme, change timeframe settings, or add levels. Additional levels may be needed to track signals within a particular trading system. MACD levels, setting up. Once the indicator is set up and placed on the chart, you can start trading. There are both simple and complex strategies for trading using the MACD. To understand how the indicator works in practice, we will analyze several such vehicles. Simple MACD trading strategy. The simplest MACD trading strategy does not require any additional indicators to be installed. The signals of one instrument are enough to find the entry points to the market. Transactions on this vehicle are opened as follows. If the MACD histogram crosses the moving line from bottom to top, a buy trade is opened. If the histogram crosses the moving average from top to bottom, a sell position is opened. Examples of MACD signals. Stop loss is placed below the minimum of the candle at which you entered the market when buying, or above the maximum when selling. Take profit is set 3 times more than the stop loss, or at the nearest key price level. Trading on the convergence divergence of the MACD. Convergence divergence of the MACD is one of the strongest signals that this indicator gives. It is expressed in the divergence of the direction of movement of the MACD histogram and the price chart. To determine the divergence, you need to connect 2 corresponding peaks or troughs on the chart and the indicator. It looks like this. Divergence on the EUR/USD/H1 chart. The chart shows how after a strong downtrend, the price slowed down, corrected up, and then went down again, updating the minimum. At the same time, a local minimum was also formed on the MACD, but higher than the previous one. This was a signal that the movement has run out of steam, and the probability of an upward price reversal is high. Although this is not visible on the chart itself, the indicator gives a leading signal, and this is precisely its value. Divergence trading is conducted as follows. When the indicator draws the second minimum above the first, you need to prepare to enter the purchase. Entry into the market occurs when the reversal is confirmed by a breakdown of the upper trend line resistance. Convergence differs from divergence in that the lines drawn on the chart and along the vertices of the histogram do not converge, but diverge. The line on the chart is directed up, and in the indicator window, down. Convergence on the EUR-USDD1 chart. In this case, if the price breaks through the support line of the price channel on the chart, a sell trade is opened. The MACD strategy. In order to increase the efficiency of trading, you can use other indicators in conjunction with the MACD. Since the MACD itself is an oscillator, the second tool is best to make a trend indicator, and the simplest and most effective is to use the MA. Buy and sell signals for such a system will look like this. If the price chart crosses the moving line from top to bottom, and the histogram crosses its moving line in the same direction, a sell trade is opened. If both intersections occur from the bottom up, a buy deal is opened. Signals of the MACD strategy. Due to the fact that indicators filter each other's signals, the number of false market entries decreases. Despite the fact that this system can also produce unprofitable trades, they are compensated by taking a large profit from a powerful trend. A complex strategy with the addition of MA and RSI. The rule: the more indicators, the better does not always work. But technical analysis experts agree that it is quite acceptable to add up to 5 indicators to the chart. For now, we'll focus on 3, the MACD, the MA, and another oscillator, the RSI. In this case, the use of 2 oscillators at once is quite justified. While the MACD helps determine the direction of opening a trade, the RSI determines the optimal entry points. This allows you not only to enter in the right direction, but also to take the maximum profit from the movement, or refrain from opening a position at all if the moment is already lost and the trend is weakening. Buy deals based on a comprehensive strategy are opened under the following conditions. The price chart crosses the MA from the bottom up. The MACD histogram crosses the moving average in the same direction. The RSI enters the oversold zone below the 30 level, and then crosses it from the bottom up. Buy signal for the MACD RSI MA strategy. Sales transactions are opened in a mirror situation. In this case, the RSI plays the role of a powerful filter, not allowing you to enter the market too late, and the MA and MACD, in turn, filter false entries into the overbought and oversold zones of the RSI itself. What trading signals does the MACD indicator give? Now it's time to move on to the most important thing: what trading signals the MACD indicator will give us. So, the MACD can give 4 main trading signals. 1. Determining the direction and strength of the trend. If the histogram is above the zero line and the highs of the histogram bars consistently increase, then there is an uptrend in the market. Accordingly, for a downtrend, there is a mirror situation. This method of determining the trend on the daily and older periods was proposed by Alexander Elder in the 3 screens strategy. In addition, this method allows you to assess the strength of the trend. The logic of the process is simple. The greater the distance between moving averages, the higher the bar of the histogram, and accordingly, the trend is more stable. 2. Local minima and maxima of the histogram. The formation of local lows and highs on the histogram indicates that the price is beginning a correction or reversal. Please note that a price reversal cannot be determined based on the readings of just one indicator. It must also be confirmed by other indicators. 3. Crossing the MACD with the zero line. As we wrote above, the intersection of the zero level histogram corresponds to the intersection of moving averages, which in classical trading is interpreted as a signal to enter the market. That is, if the MACD histogram crosses the zero level from top to bottom, it is a sell signal. If from bottom to top, it is a buy signal. It is worth noting a very important point. There is no clear opinion among traders. Some consider this trading signal to be the strongest one that can be received from the MACD. Some traders claim that trading at the intersection of moving averages is complete nonsense. We believe that this method will only work if the indicator parameters and time frame used are selected correctly, in addition to confirmation from other indicators. 4. Using divergences. A forex divergence is a divergence between the price direction and the indicator direction, which is interpreted as a prerequisite for a rapid trend reversal. In the case of the MACD, the divergence is determined between the price directions and the consecutive rising or falling bars of the histogram. Note that the histogram peaks are considered only above or only below the zero level. When the histogram crosses the zero line, the divergence is considered sparse. Used in combination with other technical analysis tools. There are many systems that include the MACD in combination with other tools. Most often, the MACD divergence is used as a preemptive signal, and a specific entry point is selected based on other indicators. Good results are shown by systems that combine the MACD and the usual resistance as support levels on lower time frames. With this approach, properly selected MACD settings and clearly formulated rules for entering exciting a trade can significantly improve your trading.